All right, so you've got $10,000 sitting in your account right now, but here's the problem. If you don't invest it wisely, you could lose it through inflation or bad investments. So in this video, myself and my AI assistant Tiara are going to show you exactly how to invest that $10,000 like a millionaire would. And stick around because I'll also reveal the one mistake that most people make with their first $10,000 that can completely derail their financial future. So Tiara, how should we start this one?
Let's jump right into the investments.
Yeah, so good idea. So that's really what they clicked for, right? So let's just dive right in. So when you're starting with $10,000, the key is to focus on an investment strategy that balances growth potential with diversification to reduce your risk. So the idea here is to allocate your money across different types of investments that work together to build wealth over time, right? We're not getting rich quick. So for this portfolio, we're aiming for the stock market's historical average return of 10% annually. Now, I'll talk later in the video about how you can kind of adjust the strategy to try to get a higher return, but the last thing I want to do here is give you risky investment advice that could end up making it so that you potentially lose that $10,000.
I'm talking about normal people, working class, everyday people. Everyone wants to get rich. Am I crazy?
So here's how we're going to break this down. So first we'll put $7,000, which is 70%. Those are going to go into index funds. So this is the core of the portfolio. And index funds are kind of like the backbone of any good investment plan, right? They give you exposure to hundreds of companies without having to pick individual stocks. So for this, I'd recommend two different Vanguard funds. So Vanguard S&P 500 ETF, which is VOO. We're going to put $5,000 there. And this tracks the top 500 US companies like Apple, Microsoft, Amazon, and it's super low cost with an expense ratio of just 0.03%. Next would be the Vanguard Total Stock Market ETF, which is VTI. And here you want to put $2,000. So this one, it covers the entire US stock market, including small and mid-cap companies that aren't in the S&P 500. So it gives you a little bit of extra diversification. Next, we want to take $1,500 or 15%. That goes into a sector-specific ETF. So here's where we can kind of spice things up a bit by focusing on tech, which is one of the fastest growing sectors in the market. Now, I go with the Vanguard Information Technology ETF, which is VGT. Now, this is packed with companies like NVIDIA, Microsoft, and Tesla, which are basically the powerhouses that are driving all the innovation, in our society today. And then I take $500, which is 5%. I'd put that right into crypto.
Or as I like to call it, the Vegas section of your portfolio. Roll the dice, baby.
Okay, I don't think that it's that risky, Tiara, but yeah. I know crypto, it can be intimidating for some people because it's volatile and it is the riskiest part of this portfolio by far. But I'm a believer in it, so I'd say that we're putting the 5% here for that kind of high risk, high reward potential. And I'd split it between Bitcoin, I'd put $300 into Bitcoin, and Ethereum, I'd put $200. These are the two, most established cryptos, and they'll give you exposure to blockchain technology without ever really kind of going overboard. And then finally, I'd take $1,000, which is 10%, and I'd just keep that as cash, right? Now, this might sound crazy, but you want to keep some in cash. This is your safety net and also an opportunity fund. So you want to keep it in a high yield savings account or a money market account where it earns some interest, but stays liquid. That's the key. That way, if there's a market dip or you need, quick cash for an emergency, you're going to be covered.
You smell that? What is that?
Opportunity.
No, money.
So this breakdown, it gives us a portfolio that's, growth focused, diversified across different asset classes. So we have stocks, tech sectors, and crypto, and it still maintains some liquidity with cash reserves. All right, so now that we've kind of gone over what my recommendations are for the portfolio, right? Tiara, what's next from here?
Let's talk about risk tolerance.
Great. We can do that. So let's talk about how to adjust this portfolio kind of based on your risk tolerance and also your age, because not everyone is going to feel the same way about investing $10,000, right? Some people, they'll want to play it safe while others are ready to kind of go all in for growth. And if you're looking for potentially, higher returns, that might be the right move. And also your age is going to play a big role here too. So think of it this way. How much are you okay with seeing your portfolio go up or down? If you're someone who is going to check your account every day and panics when the market drops, you're probably more conservative. But if you're like, I'm in it for the long haul, this doesn't really matter about this drop today, then you can afford to take a little bit more risk. So now, if you aren't too familiar with your own risk tolerance, I'll have an entire video all about it that I'll share by the end of this video for you to kind of help you out with that. But for now, here's how the portfolio will change based on the different general risk tolerance profiles that there are. So first off, as a conservative investor, so you're all about stability, right? You want steady growth growth, but don't want to lose sleep over market swings. So here's how I'd adjust it. I'd put 80% into index funds. I'd stick mostly with VOO and VTI because they're reliable and less risky. I'd put 10% into, just cash. You want to keep a solid safety net that you have, like a buffer. I'd put 5% into the sector ETF, into tech basically. So a small slice in tech, very little growth potential without going overboard. And then I'd put 5% into crypto, just a toe in the water since crypto can be wild. And I know you're conservative, but live a little. Sorry, I gotta say it. A moderate investor, you're okay with some risk, but still want some balance, right? And honestly, this is the sweet spot for most people. So this looks pretty much like the portfolio that we talked about earlier, right? You're gonna put 70% into index funds, which is a solid foundation with VOO and VTI doing most of the heavy lifting. And next we take 15% and put it into the sector ETF. So a little bit more exposure to high growth areas like tech, right? We wanna focus there. Put 10% into cash, which is enough for emergencies or opportunities without holding too much back. 5% into crypto, just enough to kind of get involved without, going too deep into the risky territory. And then you'd be all set there.
Is this safe? 50-50. 50-50, what, like 50% we live, 50% we die?
Next would be my favorites, the aggressive investors. So you're all about growth and you're willing to take on more risk for potentially bigger returns. The ride might get bumpy, but you're cool with that because of hopefully you're gonna be investing long-term, right? So here's how I tweak it. So I put 60% into index funds. So still a solid base, but slightly less so that you can lean into higher risk stuff. I put 25% into the sector ETF. So this is a bigger bet on tech or other high growth sectors that you may like. And then 10% into crypto. So more exposure to Bitcoin and Ethereum, because if they take off, you obviously want some of that upside. I put 5% into cash, just a small cushion since you're focused on putting your money to work mostly anyway. And now let's talk about why age matters in your risk factor as well, because it definitely does. So your age matters because it really determines how much time that you have before you really need this money. And that affects how much risk you can actually take. So for instance, if you're in your 30s or early 40s, you've got time on your side. You can afford to be more aggressive because even if the market dips, you've got many years to recover. So maybe lean toward that moderate to aggressive range, if that's you, with more, tech and crypto. However, if you're in your mid 40s to early 50s, or even older than that, retirement, it's not that far away anymore. So balance really becomes the key. Now you still want growth, but you also need stability. So sticking closer to the moderate allocation we talked about earlier, that makes the most sense. At the end of the day, it's all about what feels right for you. So some people in their 50s, they might still go aggressive because, they love chasing the growth. That's kind of how I am, but, within reason. While other people in their 30s, they might prefer playing it safe. It all just depends on your comfort level. Now, as much as I'd love to say that you're all set once you've set up your portfolio, it really doesn't end there, right? There is still one step in the process. So, Tiara, what's next from here?
Let's get into rebalancing and staying consistent.
Perfect. So this is where a lot of people either make or break their long-term success, right? It's not just about how you start, but it's about how you keep, adjusting and building over time. So why does rebalancing matter? Well, here's the deal. So over time, different parts of your portfolio are going to be growing at different rates. So for example, let's say that the tech sector has a killer year, and your Vanguard ETF, the technology one that we talked about earlier, it grows way faster than your index funds. Or maybe, crypto takes off and that little 5% slice, it suddenly doubles in value, right? Well, it sounds great, but here's the problem with that. So now that, this has grown so much, your portfolio is kind of out of balance. If you started with 70% index funds, 15% in the tech ETF, 5% in crypto and 10% in cash, those percentages now may look like 60% index funds, 20% tech, and 10% crypto. And that means that you're taking on more risk than you originally planned. So rebalancing is all about bringing things back to your target allocations, and you want to be selling a bit of what's grown, too much and reinvesting into areas that are lagging behind. But, how often should you actually rebalance? And I have some good news here. You don't need to micromanage this. So it's not something that you should be doing every week or even really every month. Once or twice a year is really plenty. You want to kind of think of it like a checkup for your portfolio, right? You just want to, look into it, make sure everything's where it should be generally. So here's an example to show you how this could kind of play out, right? So let's say that your crypto allocation, it really grows from 5%, which is $500, to 10%, which is $1,000, because Bitcoin and Ethereum, they have a huge rally. Well, that's awesome, but now crypto is taking up a bigger chunk of your portfolio than you should really be comfortable with. So to rebalance, you'd sell $500 worth of crypto and move that money back into index funds or even cash reserves to get back to your original plan. Now, I gotta make something clear. Rebalancing, it isn't about timing the market.
Because let's be honest, if you could time the market, You wouldn't be watching this video. You'd be on a yacht, sipping something expensive.
She isn't wrong there, right? I wish I could time the market, but I digress. Rebalancing, it's really about keeping your risk level in check and sticking to the strategy that you kind of set at the beginning, which feeds into the power of consistency, which is also a really important part of this. So investing isn't just about what you do with your first $10,000, right? It's about what you do after that. That's the most important part. And I'm not only talking about rebalancing here, I'm talking about regularly adding new contributions to your portfolio, even small amounts, because it can make a massive difference over time. One of the easiest ways to do this, well, just set up automated monthly investments. So set it up so that every month, a portion of your paycheck, it goes straight into the index funds that we've already talked about. So this is called dollar cost averaging if you aren't familiar, and it works because you're buying into the market at regular intervals, sometimes when the prices are high and sometimes when they're low, but over time, this is going to average out. So think of it like this. So if you invest $500 every month into VOO for the next 5 years, even during the market dips, that's the important part, you'll actually end up with more shares at a lower average cost. And those shares, they will grow as the market recovers. And this is how millionaires build their wealth consistently. So rebalancing, it keeps your portfolio on track and consistently ensures that your money keeps growing beyond that initial $10,000.
Hey, Ron, this is a good time to discuss the one mistake you mentioned in the intro.
Yeah, you know what, Tiara, you're absolutely right, because it really ties into the importance of rebalancing, right? Thanks, it comes full circle here. So the one mistake that most people make with their first $10,000 is failing to diversify and balance their portfolio properly, which can lead to unnecessary risk or missed opportunities, right? So here's why this is such a big deal. So some people, they'll put all their money into one or two hot stocks, right? Thinking that they'll strike it big. Well, if those stocks tank, then they'll lose a huge chunk of their investment. And others might, leave all their money in a cash or low interest savings account, which means that inflation will slowly eat away at the value too. And then there are those who, they go all in on high risk assets like crypto, which honestly, it's just too risky. Don't do that. By not diversifying, really spreading your money across different types of investments, you're either taking on too much risk or really not taking on enough risk to make sure that your money has a chance to grow effectively. And that's why the portfolio that we've outlined in the video, it is so important because it balances growth potential with diversification to really manage your risk. Now that said, earlier I mentioned a video to help you understand risk tolerance, and you can watch that right over here. But if that's not for you, then go ahead and check out this other video instead. And as always, before you go away, please remember to subscribe to the channel to unlock financial success one AI chat at a time. Thanks so much for the support.